This is a lecture from Open Tuition. For the free slides that go with this podcast, please visit opentuition.com.
In the UK, accounts are regulated as follows. First, there is company law. Company law, for example, insists that companies produce accounts roughly every year. Although there are certain statutory disclosures set out in company law, by and large, company law doesn't go into huge amounts of detail about exactly how different elements of the financial statements must be shown. That's really too complex a matter to have in law, because frequent changes and great expertise is needed to decide how things should best be shown. The detailed regulations are usually found in the accounting standards. The major bodies of accountants must subscribe to the accounting standards. The system for establishing accounting standards is headed up by the Financial Reporting Council, and in particular the Accounting Standards Board issues standards. Its standards are called the Financial Reporting Standards, or FRSs. By and large, all sets of financial statements should comply with the financial reporting standards. From time to time, urgent issues arise. For example, the recent banking crisis could potentially have given rise to issues which must be dealt with very quickly, and rather than going through the full and perhaps rather slow process of establishing financial reporting standards in the normal way, the Urgent Issues Task Force can deal with these urgent matters quickly. Sometimes companies depart from the financial reporting standards, and the Financial Reporting Review Panel is concerned with examining and questioning why that has taken place. Occasionally they may conclude that departure is justified, but this tends to be a relatively rare occurrence. GAAP stands for Generally Accepted Accounting Principles. This is a common set of accounting principles, standards and procedures that companies use to compile their financial statements. GAAP is a combination of statute, accounting standards, international accounting standards, stock exchange rules, and convention. GAAP are imposed on companies so that investors have a minimum level of consistency in the financial statements they use when analyzing companies for investment purposes. Companies are expected to follow GAAP rules when reporting their financial data through their financial statements. The term internal controls refers to the collection of mechanisms whereby an organization tries to ensure that all its transactions are properly authorized, recorded, and that its assets are safeguarded. The proper management of a business, and indeed now part of corporate governance, means that there has to be a good system of internal control in place if directors and other managers are going to exercise their stewardship responsibilities correctly. The system of internal control falls into two parts. First, there is a control environment. This essentially refers to the culture within the organization. Some organizations put a very high priority on having a good system of internal control in place, whereas others see these as a nuisance. If the system of internal control is going to be effective, there must be a good control environment. Otherwise, detailed controls which are there in theory will simply be ignored in practice, because people don't feel that these are important. There will then be a system of detailed control processes. For example, if someone works overtime, you expect this to be authorized by a manager. Once a supplier's invoice has been paid, you expect that to be cancelled in some way to prevent it being paid twice. Before you send goods to a new customer, you should take up credit references, perhaps by writing to their bank, and then setting a credit limit. It should be impossible to dispatch goods to that customer if it puts them over their credit limit, and there should be a system of reviewing receivables and following up slow payments to try to prevent the occurrence of bad debts.